This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on the credit analyst. I have lots of students over the years who've gone to work for financial institutions as credit analysts. And whenever I talk to them, they can always summarize at least their initial part of their job description as trying to determine A, whether a business deserves a loan, and then B, what kind of an interest rate to assign that loan. And so essentially a credit analyst is, the first part of the line of defense for a financial institution against default risk and then other types of risk as well. So if we look at these learning objectives, you guys should be pretty happy to see that there are only a handful of these in some of these chapters. We've got 10 or 12 or maybe even more of these. But I think you'll like working through these because although it's relatively straightforward, there are some really important parts to this chapter that have great sources of questions. So this is what we're going to do: quantitative, qualitative, and research skills as a banking credit analyst. What kind of sources of information are available? And then we'll spend the last 2 or 3 slides on the CAMEL system. Let's start with quantitative skills. I've said this to you many, many times in previous videos, and this is pretty much a theme in many of the chapters, that great risk management skills include identifying the risks, quantifying the risks, and then managing the risks. And so part of that is to establish the borrower's ability and willingness to repay that loan. Now we'll start with the quantitative skills, which is going to help measure the borrower's ability to repay that interest in principal. And then the quantitative skills will measure the willingness. And that's a great testable question. So notice the essentially 3 skill sets that the chapter presents to you. A banking credit analyst must be able to, this makes perfect sense, right? Read and interpret financial statements. Not only to be able to take a look at a financial statement, which we'll do in a couple of slides, but be able to take a look at those financial statements and then arrive at some reasonable conclusions. And of course, the first step in arriving at those reasonable conclusions is to compute and interpret the ratios between and among the various accounts on the balance sheet and on the income statement. So notice the 3 that are listed there. Maybe these are the 3 most important. Let's start over in the yellow. Liquidity ratios, of course, measure the ability of the borrower to meet short-term obligations. And that's important because when we're making a loan to a business, we want to know if they can meet their short-term obligations, plus can they meet their long-term obligations, which then switches us over into the solvency ratios or the debt ratios or the leverage ratios, whatever you want to call them. And then I would argue that profitability ratios are probably the most important of any group of ratios because these profitability ratios, they typically have net income in the numerator, right? The bottom right-hand side of the income statement. And then in the denominator are things like maybe total equity or total assets or anything else that you want to put in that denominator. You want to see how profitable a firm is, a borrower is, in terms of its relationship to, something like total assets. And then, of course, quantitative skills include those that involve statistical research. So notice I have there in that middle blue box being able to not only just calculate the mean and variance and covariance, but also to be able to use regression analysis to conduct hypothesis testing. And then confidence intervals. I always do this with my students. What you essentially want is to have a borrower who has a confidence interval of this, meaning that there is absolutely no risk that the borrower is not going to be able to repay principal and interest. Of course, I'm not sure when that happens, and so we need to decide how far out do we want to go with those confidence intervals. And of course, the standard of statistical research is to compute a 95% confidence interval. I've never really seen much much good historical or statistical support for why 95% is better than 95.5 or 96 or 94. But anyway, that seems to be kind of the conventional wisdom, a 95% confidence interval. And then, of course, a good quantitative analyst must also be both a micro and a macroeconomic superstar. Of course, a borrower's ability to repay a loan depends on the larger economy. I always do this to my students. I say, look, if the economy is expanding, that means businesses are going to be able to find projects that have higher net present values, and the net present values of these current operating assets are going to be able to expand. So when the economy is expanding, then that firm ought to be expanding, and that should be revealed in all those ratios up at the top. And so what kind of expertise does a good risk manager need as a credit analyst? Well, of course, when businesses come in to borrow, they're going to want to know what the price of a bread is today, and then what we expect the price of a bread is to be next week or next year. So we need to know about inflation, and not only just the definition of inflation, but how the government computes inflation, whether it's on the consumer side, whether it's on the producer side, whether it includes oil prices or excludes oil prices, or any of those kinds of variables. And then, of course, I did this before, so we have an expanding economy, so GDP will increase. If I go like this, we'll have a contracting economy, and GDP will be negative. Now, of course, in most quarters, GDP grows, but if it grows by less than 0% for 2 consecutive quarters, that's some economics definition of a recession. But then notice what I have in the middle there. So these interest rate trends are really important, and not only just the trends as they go up and down, but the spread between maybe the interest rate charged to a local business and the rate on treasury bills or some other benchmark. And so notice here, let me summarize this slide in that a good credit analyst doesn't have to be an accountant or a management scientist or an economist, but a good credit analyst has to have those kinds of skills. And remember, quantitative skills measure the borrower's ability to repay, which should be coupled with the borrower's willingness to pay, and these are the qualitative skills. So this is going to be a subjective judgment, and this is part that I love to tell my students about this. Let me go back to this last slide. The quantitative skills, this is the science behind good financial research, and then the qualitative skills, this is the artistry behind good credit analyst skills. One of my sons really loves to draw, and I'm pretty amazed at what he can do because I have absolutely no skill in that area. But this is what it is, the artistry of being able to process and scan the regulatory environment to be able to make a subjective judgment on what that future regulatory environment might be. And of course, I need to take a deep breath here and say that regulatory environment depends on who's in charge at the country's headquarters. Here in the United States, that means Washington, D.C. So if you have one party in charge, that might be one regulatory environment. If you have another party in charge, then that's probably going to be a different regulatory environment. So implicit in these judgmental skills is the ability to process regulatory information and political information as well. Informative research on banking. And so I want you to think about taking a step back and looking at the financial institution industry from a far set of binoculars. So you're way back here and you're looking at this financial institution industry and you're making an assessment about where you believe the future growth is inside of that industry. And of course, communication skills and interpersonal skills are extremely important because in making these subjective judgments, it's quite helpful. In fact, it's invaluable to be able to talk to everybody on the supply chain, right? Even financial institutions have a supply chain. So you need to talk to everybody over on this side. You need to talk to everybody on this side. Whoever those people are, whoever those individuals or organizations or businesses are, you need to be able to have that ability to extract and infer information from business conversations. I try to teach my students this all the time. When you're having a conversation with somebody, you're trying to provide some information to that other person, but man, you can learn so much from other people. And so think about what I said just a few minutes ago. What did I say? Boy, certainly you guys know this. Identify the risks, quantify the risks, and then manage the risks. So in the previous one, in the middle one, quantitative skills, that helps us quantify the risk. But these qualitative skills, they help us identify the risk, but even more importantly, they help us to manage the risks. Now, I'm guessing that you guys know about these sources of information, right? Annual reports, supplemental information, interim financial statements. Of course, we can go to news services. At my school, we have access to the Morningstar database, which has tons and tons of information. We also have the Bloomberg terminals, which is big in the news these days. And so our students have access to just about every piece of financial information that's out there. We can also rely on ratings agencies, which we do and we should do, but we also have to remember that those ratings agencies have had pockets where they have failed to provide us with accurate ratings. So we need to rely on them. Absolutely, we need to rely on them. And one of the impressive things is these ratings agencies, after the financial crisis of 2007 to 2009, they kind of admitted some of their mistakes and said, hey, this is what we did wrong, and this is why we're never going to make those mistakes again. And so I think that's critical in terms of relying on not only their information, but information that we get from any of these other sources. Remember, there was a president that we had in the United States that was famous for lots of quotes, but he said, trust, but verify. And that's probably a good code for a credit analyst to use. Now, the annual report these days, I can't remember the last time I held a physical annual report in my hands. I remember when I was in graduate school, and even in my early days of being a professor, I would bring an annual report to class and I would show the students. And I would say something like, look at this company here. It's the greatest company that ever lived, because this annual report, notice I have the word propaganda and glossy photos. It might not be useful as an analyst. So you're tempted to kind of say, this is the best case scenario, but there's still valuable information inside the annual report. Now, there's something different between holding it in your hands and then just kind of scrolling through on your computer or on your phone or your handheld. But what's really really interesting here is that the executives, the managers, they make some comments throughout the annual report. And so you hear and you can read what these comments are, and you can grab really crucial information from, look, I have this in bold, the firm's culture, the management's competence and vision, and the business strategy. Remember, it's the board of directors that establishes that company business strategy. And so the comments that are made inside the annual report and other financial statements will probably give us lots of good information and insight into, I don't want to go back to that earlier slide. We went through that quantitative analysis and we computed some of those financial ratios. Well, suppose that we have some concerns about some of those financial ratios. We look at the annual report and there might be a comment in there where the management is not going to say something like, we stink at liquidity, but we're going to fix it in the future. But they'll have some kind of wording and some kind of speak that makes it sound like, they're aware of this problem, and then these are going to be our solutions. Now, of course, who owns a business? It is the shareholders who own the business. So the goal of the business, notwithstanding, recent kind of thoughts, the goal of the business is to maximize the value of the firm, maximize stock price, maximize bond price, maximize total shareholders' equity. And so notice what I have in that second circle point there. It is important to have an understanding of the management side of the story so as to develop useful counterpoints. That's what I was suggesting earlier. Now, of course, a good analyst is going to be on the lookout for management's take on various items. And so look at this bottom circle point that I have. If we compute these financial ratios and we're concerned about liquidity, a couple of things we can get from the annual report. If the annual report totally ignores these liquidity issues, well, then that's probably a signal that is it possible that the executives are not aware of this liquidity issue? And the answer to that is probably no. But the fact that they're not reporting it in the annual report is probably an indication that, maybe the rest of the annual report is going to be glossed over. But the important thing is to try to extract what those strategies are going to be to deal with that problem. Here are some examples. So here's Nike. We reported financial results for fiscal third quarter, et cetera, et cetera. Revenue growth was driven by a broad-based strength. So what does that mean? Nike had broad-based growth, so every one of their business units probably grew. But let's take a look at some quotes from the annual report that we can probably infer some interesting conclusions or some interesting strategy changes in terms of where Nike is going to look in this year of 2020. So I'm going to go ahead and read these. Our business momentum is being accelerated by our ability to scale innovation at a faster pace and expand new digital consumer experiences around the world. Wow, my head is exploding reading that. But clearly what that means is that Nike believes that it has faster and smarter human capital and maybe digital resources so that they can innovate at a faster pace. And what that means is, of course, at a faster pace than its competitors, which is going to expand new digital consumer experiences around the world. I will tell you this. I have a son who's in college, and my son has done this 3 or 4 times in his life. He's gone to the Nike webpage and he's designed his own sneaker. And then he designs his own sneaker and he says, "Hey, Dad, look what I've designed. Can I buy it?" And I look at the bottom and I look at, okay, the cost for designing this new sneaker is way more than what it costs if you go down to the local retail shop. But anyway, that's what Nike's talking about there. All right, diluted earnings per share, 68 cents, strong revenue growth. So we knew that from the top. Gross margin expansion, partially offset by higher selling and administrative expenses. All right, so what's the goal of the business? Maximize shareholder wealth. How do firms do that? Well, they do this in multiple ways, but essentially it's to make something for pennies and sell it for dollars. So think about the middle of the income statement versus the top of the income statement, right? So we've got gross margin expansion. So we're making it for fewer pennies and selling it for more dollars. However, we have higher selling and administrative costs. So without looking at maybe the 10K, we're not quite sure if that means we've spent lots more on marketing. Maybe we've spent more on things like pensions, or maybe we've expanded our offices. So notice what I have in the orange there. More light on earnings per share. And then we can quickly do the bottom one. In the prior period, diluted loss per share reflected the enactment of the U.S. tax cuts. So what that means, of course, is that we have this fiscal environment in which the United States government, what was President Trump? We were going to cut the U.S. corporate tax rate from 35% all the way down to some number. Do you remember during the 2016 election, some days the Trump campaign said it was going to be 15%, some days 19%, a lot of days 20%, turned out to be 21%. So an awareness of the fiscal decisions made by the federal government and how that's going to impact things like liquidity ratios and financial ratios and all that other stuff that we've talked about here. Now, of course, that annual report is put together by the internal accountants and the internal auditors. And so, of course, they're going to make decisions that present the firm in the best light possible. And if that were the end of the story, then we as good shareholders and you guys as good credit analysts could probably not rely on those annual reports for anything other than to adorn your kitchen table if you actually have a physical copy. So, of course, we need to bring in the external accountant. So we bring in a public accounting firm that is independent. Did I say that word independent? Let me say that word independent again, and let me just have you remind yourselves of our conversation that we had with Enron. But let's just assume that these independent auditors are in fact independent. So these are men and women who we don't know, and they wear a badge on their shirts that says, I passed an accounting test, 5 years ago. So they're going to come in and they're going to do all the stuff that our accountants did internally, but they're going to audit our financial statements. And sometimes that means coming in and counting our inventory. Now, of course, what that means for a financial institution, to come in and look at our loans, but for a company like Procter & Gamble, they're going to go and count, the number of Kleenex boxes that Procter & Gamble is reporting on their financial statements. And so what the accounting firms do is in the annual report, they write a little letter. They say, Dear Mr. and Mrs. Shareholder, we believe that these financial statements have been presented according to the rules of GAAP or according to the rules of the International Financial Reporting Standards or according to Jim's accounting rules. I mean, whatever that is. So that you, as the credit analyst and shareholders in general, know that the financial statements are in fact a reasonable reflection of the business reality of the firm. Now, these letters, they have a fancier name than how I just described it. And of course, the most common of these opinions is an unqualified opinion. All right, so let me read what's in the blue box there. Unqualified opinion implies the auditor's judgment is that a company's financial statements are fairly and appropriately presented without any identified exceptions and in compliance. So the external people come in and they say, you know what? If we would have done these things as an internal auditor, then we probably would have come up with something similar. Not necessarily identical, but it probably means that these are reasonable and that they're inside of that range. How about if I do this? A 95% confidence interval range, 90%, I don't know, 50%, whatever that means. And so look at these points here. In essence, it means that the auditor does not disagree with the financial statements. It doesn't necessarily mean that they would produce similar statements, but it means that they wouldn't produce vastly different statements. Now, of course, remember that as a good financial accountant, you have tons and tons of ways to present each account. Just for example, how about inventory? And so the auditors might have a specific idea about inventory. Maybe they prefer the FIFO method, but when they get inside of the business, they see that the internal auditors use the LIFO method or the weighted average or Jim's inventory valuation. So there can be differences in philosophy. I think you guys might remember that I do have an accounting degree, and so I had an accounting theory class, and I remember sitting in the class thinking that, boy, this is no fun learning about the different theories about inventory valuation. But as I've aged and matured over the years, I realized that, boy, some people can have an opinion on inventory, and it might not be very exciting, but it's probably pretty important. Look what I have at the bottom there. Minimum acceptable standards. All right. How about a qualified opinion? Well, oh boy. So what does this say? Let me read this. The financial statements might not fairly represent the company's financial performance and conditions. Oh my gosh. Let's think about what that means. Might not fairly represent. So that was the idea. Let me go back here quickly. That was the idea behind this unqualified opinion, that look at the words I have there, fairly and appropriately presented. So, it's reasonable. We don't even have to get into business language or financial language if it's reasonable, right? So this does not fairly represent. All right, so there are probably going to be some some exceptions, and they'll probably be for the following reasons. So what do I have listed down there as the causes? Substantial doubt as to the ability to operate as a going concern. Remember, going concern means that we're going to be around for a long, long time. Inconsistent with accounting rules. I kind of use this as a little bit of a comedy piece. You could use Jim's inventory valuation method or Jim's depreciation method. Well, Jim's method may or may not be consistent with, the really important people who get to set these rules. I would probably come up with something that's reasonable, but it might not be consistent with the established accounting rules. Significant amounts of related party transactions or unusual conditions or event. And notice I have that word material. This always shows up in financial analysts conferences, and it's a big word for accountants and should be a big word for credit analysts because, after all, if there's an event and nobody cares about it, it doesn't have any material effect on solvency ratios or profitability ratios, then we probably don't really need to care about it. Or, we could raise our eyebrow like my dad used to do to me and keep it in the back of our mind. But unless it has a material impact, then we probably don't worry about it. But that's part of this qualified opinion. Notice what I have up there at the top. It's even if it is phrased in diplomatic language, and even if the bank can conveniently hide behind the leniency of some regulations. I always think of regulations as the cloud of fog. And, if you wake up in the morning and it's foggy out there and you can't even see your hand in front of your face as you go out to get the morning newspaper, well, that's tremendous regulation. But, if you can see across the street and down the street, there's leeway in there about what might be regulation and what might not be regulation. So as a good credit analyst, we need to investigate the exact nature of the qualification, how severe it is, and then what the impact is going to be. Now, sometimes an adverse opinion shows up, although it is extremely rare because there's a relationship between the auditors, the independent auditors, and the firm's executives and their accountants. And so before it gets to an adverse opinion, there's probably some conversation that goes on, and the accountants sometimes just walk away and say, look, I can't do this. There's no way I'm signing off on this. And other times, there is a way to resolve some of these issues. And it basically comes down to the executives and the accountants being willing to say, you know what, we stink in this area and let's put it right here rather than try to hide it. So what does this adverse opinion mean? Indicating that a company's financial statements are misrepresented, misstating, and do not accurately or reasonably reflect its financial performance. 3 financial statements. I bet you know these by now. Let me go ahead and just give you the summary of what I learned back in my undergraduate days. The balance sheet is like taking a picture, click, click. So it's a picture of what the firm owns, we call those assets, and what the firm owes, we call those liabilities and equity, or in the case of financial institution, we call it capital. So it's just a picture of the relationship between its assets and where it got the capital to pay for those assets. The income statement is a movie. I don't even know if you do this anymore. If you take a movie, I guess you just point and shoot and click and all that kind of stuff. And so the income statement is the profit and loss statement over a time period, like a month or a quarter. And then the statement of cash flows, and this is extremely important for non-financial institutions. It's less important for financial institutions just because of the nature of the business. But that statement of cash flows determines how much cash is coming in versus how much cash is going out. And what I have done here in the next series of slides is just take a quick look at the balance sheet for Nike, since we did Nike a little bit earlier. Total assets in 2018, what is that, about $22.5 billion. So total liabilities and equity is about $22.5 billion. Remember that fundamental accounting equation, assets equals liability plus capital. One of the interesting things here of the Nike balance sheet is you take a look at the bonds under long-term debt. What is that about? 3 billion or 4 billion, whatever that number is. So let's say 3 or 4 billion out of the 22.5 billion is the bond issue. So this goes a long way in determining Nike's ability to repay principal and interest on its bond issue. We look at the income statement. What did I tell you just a few slides ago? We want to make something for pennies. So what are we making pennies? We've got, what is that cost of sales? That's about 20, right? And then we have operating overhead expense. That's about 7. And then demand creation expense. Isn't that a fascinating way of saying something like marketing expense, or let's figure out another way to get Jim's son to spend more money on his custom-made sneakers. So what if you add the 20 and then the 3 and the 7, you get about 30, right? So we're making something for 30 and we're selling it for 36 for Nike. And then at the bottom we have a net income, and then we do EPS there at the very bottom. Statement of changes in cash flow, and we divide these into 3 sections. We have the operating cash flow, which is essentially the making something for pennies and selling it for dollars from a cash standpoint. Remember, we forget about accounts receivable there. But then there are investing cash flows, because what we can do is we can take some of our capital and we can buy a new piece of equipment. And then there are financing cash flows, because we can go into the bond market or the stock market and we can raise capital to pay for those assets. So it's important to distinguish between and among what we're getting from operations. So I always tell my students to think of those operating cash flows as the cash flows generated by the assets. And then the investing and financing has everything to do with the right-hand side of the balance sheet. Look at the top there. So I did hint at this just a second ago. The statement of cash flows for non-financial institutions is probably way more important for a company like Nike and Procter & Gamble than it is for evaluating a financial institution like Wells Fargo. Balance sheet and income statement are the most important. But we can also go into the statement of changes in capital funds. So think about that right-hand bottom of the balance sheet. Is critical for a financial institution, because that provides, kind of the buffer. And that's where all of the regulation comes in. The federal government and state governments come in and say, you know what, you need to have a certain amount of capital so that if somebody shows up at the bank and they want their deposits back, you have this, this kind of a support system. It's ironic here that I'm doing this right in the middle. Boy, I don't even know how to say this. Or are we at the beginning? Are we at the middle? Or are we at the event or the end of the coronavirus? Hopefully by the time you guys listen and watch this video, we'll be at the end. We'll be saying, okay, we're sad that all this happened, and we're glad that governments and individuals and organizations were able to pool their resources and attack this. But it's clearly a good addition to this title of this slide: news, internet, security, pricings, data. So what do I have there? Mergers, acquisitions, layoff, corporate restructuring. So those are events that occur inside of the financial institution. But then there are external events, like these exogenous events that occur as well. Just last week, we had the stock market opened and closed every day, and we were wondering, oh my gosh, is it going to be a 1% loss today, or a 2% loss, or a 5% loss? So we had these series of losses because businesses and economies were just simply shutting down, which means that sooner or later, that lack of productivity is going to show up on these financial statements. And then it is coincidental, or it's ironic, or at least it's interesting. We're going to use the example of Bloomberg Markets down there at the bottom. We have Michael Bloomberg, who is a presidential candidate. Let me do ratings agencies first, since we did this. We talked about this just a few minutes ago. So these ratings agencies, people like Moody's and Standard & Poor's and Fitch, these are independent agencies that come in and evaluate the credit worthiness or the default risk of a borrower. whether it's a bond issue or commercial paper or any other kind of a loan, these ratings agencies will come in and they will do all of the same stuff that I've been talking about in this slide. Now, the prospectus is an announcement or a piece of information that alerts investors to either a bond issue or a stock issue. And these prospectuses are highly informative, but they tend to be conservative. And so a prospectus for a company like Nike will say something like this: hey, hey, Mr. and Mrs. Investor out there, could be a bondholder, could be a shareholder. Hey, all you people with lots of money out there, we want to borrow $5 billion because we want to put this machine together so that when Jim's son orders a sneaker, it doesn't take 2 weeks to get to his house. It only takes 2 days. So when Jim's son clicks that order button and he pays that higher fee, that immediately goes over to this new machine, and we start plugging away and doing all this stuff. And next thing you know, there's a sneaker and it's made in, I'll pick a number of minutes, 45 minutes, and then we immediately ship it to Jim's house. Now, in this prospectus, not only is the motivation for the bond or the stock issue critical, all right, so we're going to invest in this asset, but then how are we going to repay this? And the answer is going to be inside of that prospectus. There's going to be a picture of my son, and they're going to say, look, Jim's son is going to do this 4 times a year, where in the past he only did it once every other year. So these are expectations for repayment. And then I did tell you that we'll spend just a moment on the CAMEL system here in the last couple of slides. And so this goes back hundreds and hundreds of years, or what do I have there? At least until the 1970s. But since the beginning of financial institutions or these merchant banks way back in the old days, these 5 factors were really important: capital adequacy, asset quality, management, earnings quality, and liquidity. And so I have a couple of slides. Actually, they start right here, but let's go ahead and let's do this slide first. So notice these ratings are just like Moody's or Standard & Poor's or Fitch. What do they tell us? They tell us that a safe bond has a AAA rating, and a really risky bond has a C rating, and there are all those slices in between. Well, in this system, we can go from 1 to 5. All right, so of course, a 1 is best and a 5 is worst. But notice what I have there in that second block point. More generally, financial institutions with an average score of less than 2 are considered to be of high quality. Greater than 3, less than satisfactory quality. And probably the regulators are going to be aware of that and come in and take a look at all of the financial statements. So let's go ahead and look at these 5 points. So capital adequacy, the bank's capacity to absorb losses and meet all its obligations. So what did I say just a minute ago? We needed that capital on the bottom right-hand side of the balance sheet to perform a few functions, right? If we're a financial institution, we have all these deposits that are at the top of the right-hand side of the balance sheet. So if those depositors, if they come in looking for all their money, we need to meet those obligations in addition to our things like accounts payable and taxes payable and notes payable and all those other kinds of things. But we also need a buffer. We need a cushion to absorb losses that may occur because the Dow Jones Industrial Average loses 2 or 3% for 5 straight days. Asset quality. This is what I preach to my students all the time. What's the goal of the business? Goal of the business, any business, is maximize shareholder wealth. How do we do that? We invest in assets that are going to generate lots of cash flows. So I always talk about the quality of the assets. And of course, for a financial institution, this means the quality of the bank's loans. Now, a good financial institution is going to have a diversified loan portfolio, some really safe loans, some medium risk loans, and then some higher risk loans, of course, to be able to charge and demand different levels of interest rate on each of those loans. How about management quality? we're looking at the executives, the upper executives. We call these, in my regular old finance class, we call these financial managers, but these are the upper level executives. And of course, this includes the board of directors. I always take my students through a couple of different pictures of board members to give them a sense that, going back to stock market crash of 1987 and then some other things that have happened since then, is that, most of these boards now, in fact, I would say the overwhelming majority of these boards have a majority of independent board members. This is really important. And so it's that board that establishes the vision and the mission and the strategy for the financial institution or the firm. Now, this next, the E in CAMEL stands for earnings, but we need to swing back up to asset quality. So notice what I have there, the ability to generate returns needed for the expansion and attainment of required capital levels. So these are linked. And so notice in that bottom block point, I have the ability of the bank's growth, the ability of the bank to generate stable earnings, and then, of course, the asset liability management strategy that goes along with this. So those earnings is important. Quality of the earnings is linked back to the quality of those assets. And then liquidity is a big issue. Of course, we've got cash collected over here on the top right side of the balance sheet. And then, we lend that out to in the short term as well. But most of these are generally longer term loans. So there's a disconnect. There's a de-link in there. And that's why duration management, asset liability management, and being able to compute things like covariances and variances between and among liabilities and assets is so important, to be able to identify banks that are in good liquidity positions versus banks that might have liquidity issues. And I think that takes us all the way to the end. And so we covered those 3 learning objectives.